Welcome back to the Options Blueprint. I'm Alex.
And I'm Ben.
Ben, I want to start today with a controversial take. I think if you have a portfolio under $25,000 and you are purely buying and holding stocks in this current market, you are essentially wasting your time.
Ouch, coming out swinging today. That's going to hurt a lot of feelings, Alex. We've got people listening who just bought their first share of Nvidia or Tesla thinking they're on the path to retirement.
Look, I'm not saying stocks are bad. I'm saying the math doesn't work for rapid growth. Let's look at the current market scenario, right? We have the S&P hovering near all-time highs, we have interest rates that are likely staying higher for longer, and we have the AI sector carrying the entire market on its back.
Right, it's top-heavy. It feels precarious.
Exactly. So if you're a small account trader, you have two problems. One, capital efficiency. Buying 10 shares of a $200 stock cost you $2,000. If it goes up 10% this year, which is a great return, you made $200. You can't live on that. You can't compound that meaningfully.
And problem number two?
Directional risk. To make money on stocks, you have to be right. You need the stock to go up. If it stays flat, you lose. Opportunity cost. If it goes down, you lose. That is a 33% probability of winning best case.
So this brings us to the topic of the day. We're talking about switching sides, moving from the gambler to the casino. We're talking credit spreads.
Credit spreads, specifically why they are the superior vehicle for this specific choppy, high valuation market.
Let's break it down for the guy who has only ever clicked buy on Robinhood. What is the fundamental difference in mindset between buying a stock and opening a credit spread?
The difference is hope versus probability. When you buy a stock, you hope it goes to the moon. When I sell a credit spread, I don't need the stock to do anything. I just need it to not do one specific thing.
Draw a line in the sand.
Exactly. Let's take a real-world example right now. Look at a stock like AMD. It's volatile. It swings. A stock buyer buys at 160 and bites their nails, praying it goes to 170. In a bull put credit spread, I am selling a put option at, let's say, 145 and buying a protective put at 140. I am collecting a credit, cash, up front. Let's say I collect $100 for that trade.
And here is the magic part. What happens if AMD stays exactly at 160 for the next month?
I keep the $100.
What happens if AMD goes up to $200?
I keep the $100.
And what happens if AMD drops from 160 down to 146?
I still keep the $100. The stock dropped, and I still made max profit. That is the edge. In a market like this, where we see these massive intraday sell-offs followed by rallies, being directionally agnostic is a superpower.
Okay, playing devil's advocate here, you mentioned small accounts. The stock guys argue that options are dangerous, that you can blow up your account. Why do you say this is safer or better for small accounts than stocks?
It's about leverage and defined risk. If you want to control 100 shares of a $100 stock, you need $10,000 cash. Most people listening don't want to tie up $10K in one trade. With a credit spread, your collateral, the money the broker holds, is just the width of the spread minus the credit you received. In that AMD example, I might only need to put up $400 of collateral to make that $100 profit.
So let's look at that ROI. Making $100 on $400 risk, that's a 25% return on capital in maybe 30 days.
Exactly. Try getting a 25% return on a stock in 30 days without getting lucky on a meme coin or an earnings surprise. It's nearly impossible consistently. With spreads, you're hitting singles and doubles, but you're doing it with high probability. Let's talk about the current market aspect again. We are seeing something interesting with VIX, volatility index, and implied volatility. Why does that matter for credit spreads right now?
Great point. When markets are nervous, like they are now with inflation data and Fed meetings, option premiums get expensive. People pay more for insurance. Remember, when we trade credit spreads, we are the sellers of options. We are the insurance company.
So when the market is scary, the premiums are juicier.
Yes, if you buy stocks in a volatile market, you get chopped up. If you sell spreads in a volatile market, you get paid more for the same risk. You want to be selling shovels in a gold rush, and you want to be selling umbrellas in a rainstorm. Right now, it's raining.
I want to pivot to the mechanics of theta, because this is the silent killer of stock buyers and the best friend of the spread trader.
Theta is time decay. An option has an expiration date. Every day that passes, that option loses value. If you buy a call option, hoping the market goes up, time is your enemy. You are fighting the clock. When you sell a spread, Time is your employee. You wake up in the morning, the market hasn't moved, but your position is profitable because one day passed. You are getting paid for waiting.
I love the analogy of being the house, the casino. It doesn't care if red or black hits on the roulette wheel every single spin. They just care that over 1,000 spins, the green zero ensures they win mathematically.
Precisely. When you trade credit spreads, you structure the trades, you have, say, a 70 or 80% probability of profit. You can mathematically see your win rate before you click submit. Stock traders are guessing. I think the chart looks good. That's a 50-50 coin flip. My platform tells me, Alex, you have an 82% chance of keeping this money. I'll take those odds every day.
Okay, Alex, we have to address the elephant in the room, the steamroller. The critics of credit spreads always say it works until it doesn't. You're picking up pennies in front of a steamroller. If the market crashes, you lose your collateral. How do you manage that in a small account?
That is the cliche, right? And it's true if you are an idiot with risk management. The steamroller happens when you over-leverage. If you have a $5,000 account and you put $4,500 into one Tesla bull put spread and Elon Musk tweets something crazy, you're wiped out. But that's not the strategy.
So what is the strategy?
Small bets, high frequency. If you have a $2,000 account, you trade spreads with $100 or $200 of risk. You trade 5 or 6 different tickers, maybe a spread on SPY, one on Google, one on Amazon. If one goes against you, you lose $200, but the other 4 expire worthless and you keep the profit. The math of large numbers works in your favor.
And you can also manage the trade, right? It's not set it and forget it.
100%. If the stock challenges your line in the sand, you close the trade. You take a small loss. You don't hold on to a loser hoping it comes back. That's a stock trader mentality. As a spread trader, if the probability shifts against me, I fold. I live to play another hand.
Let's look at a concrete setup for this week. The market is hesitating at resistance. Tech is extremely overbought. What is a trade structure that makes sense?
I'm looking at something like a bear call spread on the QQQ, the NASDAQ. Everyone thinks tech is invincible, but we are stretched. I don't want to short the market because that's dangerous. Markets can remain irrational longer than I can remain solvent. So I'm going to sell a call spread well above the current price. Let's say QQQ is at 450. I'll sell a spread at 465.
So as long as the NASDAQ doesn't rip another 4% in the next 2 weeks, you make money.
It can go up a little bit. It can stay flat. It can crash. In all 3 scenarios, I win. The only way I lose is if we have a massive, unexpected melt-up. And even then, I have a stop loss. Compare that to buying a put option. If I buy a put, I need the market to crash now. If it stays flat, I lose my money.
It is really a shift in psychology. You stop trying to predict the future and start trading the probabilities of where the price won't go.
That's the tagline, Ben. Predicting where the price won't go. It is infinitely easier than predicting where it will go. Support and resistance levels on charts, they are usually respected. Not always, but usually. Credit spreads allow you to monetize that usually.
So for the listener sitting on $1,000 or $2,000, feeling like they're priced out of the market because they can't afford 100 shares of anything good, what is the first step?
Stop looking at PE ratios. Stop reading news headlines hoping for a breakout. Learn the mechanics of a vertical credit spread. Learn what delta means, specifically looking for the 20 to 30 delta range. And understand that your goal is income generation, not hitting a jackpot. If you can grow a small account by 5% a month using spreads, which is doable with proper management, the compound interest over 5 years is life-changing. Buying and holding the S&P 500 will give you 10% a year. Do the math.
The learning curve is steeper than stocks, but the control you have over your P&L is unmatched.
It's a business. Stock picking is a hobby. Credit spreads are a business. You are selling a product, risk transfer, to the market. And business is good right now.
Well, there you have it. If you're tired of watching your stocks trade sideways for 3 months while inflation eats your cash, maybe it's time to become the house.
Stop gambling, start trading. Thanks for listening to the Options Blueprint. Don't forget to like and subscribe. See you soon.